Good morning again, everybody. Thank you for joining the conference, and thank you for joining the opening CEO panel. I'm here with four esteemed panelists. They don't need introduction. Andreas, Paul, Mark, and Thierry, leading of premier institution in the insurance space. And again, their name goes without introductions. And we're here with you for the next 45 to 50 minutes to discuss about leading through change. The opening remarks already highlighted how much change is going on in the industry, and our panelists will try to shed some light on their views on this moment in times. Dive into it. I'm going to touch a few points, and I'll have our panelists giving us their perspectives. The first point, we cannot ignore: the market is changing. We lived one of the longest hard cycles in the insurance industry. Things seem to change a little bit. At least we have, the wind is changing. Is that something we've seen already, or is something new? I'd like to ask Andreas, your perspective, how you see the market today. What's new in the market?
Well, what's new? We came from Monte Carlo. People are in Baden-Baden now, so obviously everybody's talking about rates. But it was somehow boring because people expect a pretty stable renewal. So then people are shifting to other topics. So what are those other topics? Again, AI. It's a big buzz. But I think we live in a time where we can't qualify really because it's multipolar. There are many, many events coming our way. We're being challenged. The interconnectivity is the issue, and also that everything's happening at the same time. So and I think it's a bit overwhelming at times. But then I reflect and say, look, is this only our perception for today? What about our parents or our grandparents? I think they also experience stress in the system. I grew up in the post-Second World War society. I didn't have the stress that my parents had or my grandparents. So we should embrace it as a constant also and deal with it. No panic. Strategic patience, I always say. Read the facts, try to interpret it, and make sense of it. But it's important as leaders that you get your teams behind you, because if you feel uncertain or shaky, how must they feel? So I'll leave it there.
Thank you. Thank you, Andreas. No, very, very interesting opening. Thierry, I want to go back a little bit to the market cycle and think whether you think this is beginning of a real softening cycle or if it's just a little bit of a tilt in a solid market fundamentals.
Yeah, I think building on what Andreas said, I think that the cycles, right, play more or less always the same way. So capacities are building, overcapacity is building, and prices adjust downwards at some point in time. I think that's more or less the psychology of a cycle, and I truly believe it's unchanged. When capacity gets ample, then that good is of less value. And on top of it, I think in our industry, it's very tough to put the price. You know, the price of goods sold is always a little bit unclear, right? Unless the models are just great, which they are not always, right? So that's a challenge. I do believe, however, that this one could be different because we have the overcapacity is built by incumbents. All the incumbents have or still remember the last soft cycle. They really don't want to go back to that cycle. And as that memory plays an important role in the psychology of renewal, I think those incumbents will be more reluctant to let the cycle go back to real soft cycles. New capacity was very little. We remember 20, 30 years ago, so we had these new Bermudians. That's very sticky capital, right? That looks for premium against it. However, now we see more sidecars, private equity type investors. I think if the terms are not so attractive, they will just pull back and leave the market again. So those two elements, incumbents, more disciplined, plus certain capacities that will leave the market again if terms get unattractive. leave me with the hope that this time it might be a little bit different. Although hope is part of the problem of every soft cycle and makes a soft cycle even worse.
It's softer. And as insurance, we don't live on hope. No, we live in data. So that's no. Thank you. Well, playing the cycle to me seems like playing market timing in trading. It's very difficult. Love to ask Paul and Mark. You're operating from a primary perspective, from a primary carrier perspective in this market. How can you take advantage or defend yourself in this cycle dynamics? Mark, do you want to get started?
Sure, yeah, and I think I was going to start by saying, and Key is a business where we set up looking at the future, and I think you always have to have multiple time horizons in view. So if you wait for the market to change and then try and do something about it, I think you're a bit too late. So I'd say scanning ahead is really important, and anticipating changes, and we certainly could have anticipated these changes a couple of years ago. The other thing we try and do at Key, and this is really built into our DNA, is to listen to our customers. And our customers really are brokers using our platform and using our capacity in Lloyd's of London. And this is again something we've done from the start. So we've been watching very, very carefully what's been happening in the broker landscape. Two big shifts, I think, in the last 2-3 years. One around facilitization and how the brokers are trying to harness capacity themselves to make themselves more efficient. And then secondly, there have been some green shoots around digitization in the broker landscape. If you have to look quite carefully, they are there. And there are people trying to change attitudes and change the fundamental infrastructure in broking houses that we deal with. So to me, those are two changes that have been happening in the background. And as I say, if you anticipate then the softening of rate and think about how that plays through into the broker landscape, I mean, obviously on the carrier side, it can be quite painful for us, but it's also quite painful for brokers, and it means the free revenue growth of the last 6-7 years, driven by rate increase has gone. So that translates to a lot more margin pressure. So if you take that combination of changes coming into the market conditions we find ourselves in today, I think the conditions are ripe for change. And as we're talking about today, technology maturity and AI maturity in particular, I think is going to a really fascinating point. So to me, putting those few different factors together gives us an opportunity to really try and address some issues that frankly haven't been addressed in good times, in the harder market conditions we're coming through, and try to evolve the way we do business, find new efficiencies and solve some problems that have hung around for a while now.
I really like Mark, saying every market condition is an opportunity to do better and to learn from what we haven't done and to do it better. Paul, I'm going to you. How you see this cycle? Is it an opportunity or is it more of a threat in your business?
No, GB, I mean, we're in different markets to perhaps what the other panelists have been talking about. So, if you take our business in South Africa, we're the biggest P&C business. I'd say that the personal lines businesses, there is likely to be some softening of rates there. I mean, premiums have been pushing the last 3 years way ahead of inflation. And that's very hard for consumers to bear. So there will be a certain amount of pressure, and there's a lot of competition. There are a lot of people who actually direct digital or call center based businesses. So I think there'll be a bit of pressure there in the property market. Actually, I don't expect any softening of rates because that market has been unprofitable for many years. We've been raising rates. A lot of participants have actually dropped out of the market, and why would we do anything now? We've also been building up lots of reserves. It's the 7 years of feast that come before the famine. It's a good idea to store things away. So there's a bit of that as well on our side. Across Africa, we don't experience a great deal of competition, so I don't think that there'll be much there. And then in India, our P&C business is basically an investment business. So, our premium or our assets are roughly 7.5 times our premiums. So it's all about investment return, not so much about underwriting margin. So, it's a different game.
Paul, thank you. Reminds me that we talk about an insurance industry, but it's not one industry. It's multi-local. Every market, every segment has very different dynamics and cycles to a certain extent. There is, however, and Andreas, you mentioned at the very beginning, one constant seems to be impacting the whole industry, which is AI. Technology is everywhere, and AI is becoming the big theme. We see the big tech companies reaching valuation that were absolutely unexpected or unpredictable only a few years ago. NVIDIA at 4.5 trillion, twice the stock market of Switzerland altogether. It's just mind-blogging. Andreas, I'm going back to you. What do you think? What's reality and what's the hype in this race for AI?
I remember when I was in Davos and you walk there at the promenade. I mean, there was not one panel without AI. Everybody was talking about AI. It was a real hype, in particular the side events, and let me call out the consultants here in the room. Everybody was talking about AI. And fast forward a year later, it was a bit sobering. So everybody thought, okay, that's a déjà vu. When we had the sustainability hype, it was just, I think, a year before. Everybody went to Davos, made their commitments, went back home, and then the teams were saying that, why, Mr. CEO, did you do that commitment? We can't produce the numbers. We don't know how to make sense of it and to really fulfill that commitment. So then it got quiet again. Same happened with AI. So it became a bit more material because people realized, okay, what does that actually mean? So you saw a proliferation of use cases everywhere, big hype. The consultants were helping. Meanwhile, it was also new for the consultants.
Oh, yes.
So nobody knew what we were talking about. But everybody's making good money. I mean, I'm a bit cynical here, but I'm trying to get to the point to say, look, what does it actually mean, AI, and where do you deploy AI and why do you do this? And with all the use cases, and we did the same, we had a lot of fantastic use cases. We were playing around a bit, but we stopped it very quickly because it got very expensive. And you were so fragmented, you had little islands everywhere. You added complexity to the organization. And we started to measure things. So we measured data consumption. We saw a clear correlation between plenty of ideas, and then the data consumption went through the roof, the cloud consumption went through the roof, the cost went through the roof. And then consultants came in and said, oh, by the way, here's something like clouds and AI economics. So I said, okay, let's pause for a moment. What does it take to be successful with AI, and what is AI? AI is not new. We've had many, many movements or steps of machine learning, advanced analytics, etc. But you can only be successful, I would say, if you answer the necessary but nasty questions about AI, not the hypes, So, data, technology. Do you have a consistent data strategy, a data foundation, a proper front-to-end ontology to build on? Do you have an integrated global technology infrastructure? When you have an AI case, do you have a real business case approach to it with quantified benefits that you can literally see the P&L line item and track it and integrate it instantly into your data and technology inventory strategy? And we stopped it because we said we need to build the minimum governance, and we were lucky because we didn't have the big IT legacy and IT debt that our industry has. This is the big elephant in the room here. Because to get rid of that fragmented IT landscape is the biggest challenge. So I always call it the IT spaghetti underneath, and this costs a lot of money. So how do you want to make sense of AI use cases and integrate them if you have the IT spaghetti? So they will stay fragmented, single use cases for a single applications for single problems to be solved, but not as an integrated one. We believe and we think companies should invest into cleaning up their infrastructure. If they don't do this, they will fall behind. I'm promising they will fall behind because the cost doesn't go away. You've got monopolized knowledge amongst coders who go into retirement soon. Nothing is documented. This is a real problem. So that's why I'm saying I'm blessed to work in a company that a long time ago made a big investment. I mean, we doubled down on the Palantir partnership, and that pays off now.
Well, thank you for sharing. I like the IT spaghetti. I will use it. It's in Italian. I cannot refrain. Mark, I'm coming back to you. I want to go a little bit deeper on this AI topic and go at use case level or impact stories. Key is clearly at the forefront of data analytics and technology in your business. What has over-delivered in your company, your experience, and why? And what perhaps has under-delivered and why?
Yeah, I think I agree a lot with what Andreas said, and I think the key is about having a business problem to be solved and having a real clear focus on developing value and delivering value. And I think for our business is built around being data first. So Key operates in a market which is largely analog, so face-to-face trading, frankly, a lot of time with paper and email being the means of exchange of information. And we've set up a business which is data-driven. So we set up a platform on the web that brokers can use to get capacity. And what we've brought is speed, we've brought efficiency, we've brought certainty, we've brought 24/7 service. So those problems were there, so that the market was transacting as inefficiently for small pieces of follow capacity as it was for very large lead, very complex, very individually negotiated deals. And we're solving a problem for that follow, which could be done much quicker. So bringing the technology to bear to really deliver value is what I think has been the success. And actually, we haven't, when we first set up Key, we didn't use today's technology, right? We didn't use the future technology. We used technology that's been around for a decade and been in use in other industries for longer. So we very much focused on the problem we were trying to solve. And that meant classic data science like machine learning, frankly, and a web experience for our customers. So it's not the sort of high-end, groundbreaking technology we're talking about. So I think that's where we've had a lot of success. Things have moved a lot. If I think back to 10, 15 years ago when I was sort of experimenting with IBM's Watson, if anyone remembers that.
I remember.
That really didn't work in our space, okay? It couldn't handle the complexity of insurance, the unstructured documents. I do think we're moving into a different age now. With the current models, we've had success in operational use cases, but we wanted to use them in a human-in-the-loop type environment because of hallucinations, because they're not 100% accurate. You don't want to deploy them in the wild, if you like. So we've been using them in those operational use cases. And that's worked really well. It's built our confidence. It's built our trust in the models. And the models are moving fast now. So I would say, I agree with your comments. I do think that we need to be looking ahead, back to my earlier theme. If you look at the capability of agentic AI now, it's definitely a step up on a year ago, 18 months ago. That's what's in the hands of the user today. So what's coming in a year, 2 years from now is, I would say, going to be substantially more advanced than what we have today. And we see genuine value in those models. So the ability to ingest data and for our use cases, enhance our underwriting, that's a big unlock for me. Data is one of the constraints today, and particularly getting the data out of unstructured documents. But then also being able to work across a series of models. So to your point, Andreas, if you've got a good data structure, good model library, then you can have agents do much more, and that infrastructure is absolutely critical. But just to finish on where it doesn't work, I would say that not everything requires technology. There's still lots of things that a human process or a simple integration can solve much better than the latest AI, and I think the cost point is absolutely critical. So spend the money where it has real impact and delivers value. And we've had plenty of ideas come to us, and we're fortunately got a talent pool who understands the technology and where it's used best. If it's not suitable for AI, then don't use AI, right? Use something simpler. Use a human or use an integration. There's lots of ways of solving the problems.
I'd love to continue. This is really a very big topic, but clearly it's a sense from Andreas and Mark that there is a lot potential in AI, but at the same time that capturing the value and monetizing those investments is still a challenging question. But Thierry, I'm coming back to you in a second. I think there is definitely one segment in the market that is ahead of the game, the cyber criminals. And we see more and more those malicious actors using technology and AI to do damages and to create losses to the industry and to our clients. Love to get your thoughts. What's going to happen if the cyber criminals are too much ahead of the game, or if at a certain point you cannot distinguish real data from fake data, real news from fake news? Do you think that's a big challenge for the industry, or do you think you are well equipped?
I do think it's a challenge, but maybe so that you don't hear me just talk about it as a risk. I just wanted to emphasize first that I think AI is a hype and real. It's both at the same time, and I think everyone understands why that is so. I think for the insurance industry, AI is a huge opportunity. It has to be, right? All we have is data in our industry, and therefore it has to be. And we have a lot of very educated people that are good in mathematics and so on. So I think it's just probably one of the largest opportunities. And we made reference to machine learning and algorithms. All of this has been used for quite a while. But I do believe with Gen AI now we can turn words also into data, right? And so the combination of data we had and the words now, or graphs, that we can turn into data, bring together, offers all new opportunities to us. So personally, I'm very excited about the opportunity. We are also insurers of our clients that actually face cyber threats. I think that it's overall for the industry a net positive, because it's a line of business that is still very young, emerging. Today, maybe almost 20 billion worldwide. I think 95% or so underinsured, so has a huge potential in the years to come for us. Probably at some point it's going to become as big as property insurance. So that's a potential. The way there, however, is long and will be very hard. I think that our models are becoming better, but they haven't been tested really. So we will see cyber attacks getting bigger, organized. We will probably see mixed attacks between real attacks and cyber attacks. So I can imagine that tomorrow, if there is a storm already having a devastating impact on a particular region, I could imagine that that's the moment where cyber hackers will actually come in and use that weakness to make it even worse. So I can imagine a lot of combinations coming our way. So this line of business will learn a lot in the next decades. It will grow massively. So I'm very positive about it. Now, AI and cyber attacks, obviously it's a very bad marriage. It's gonna mean that they will move much faster, and they will create own attacks that human beings maybe haven't yet seen. They will detect patterns that we cannot detect as human beings. I think attacks will be much faster, much more targeted, and will be tougher for companies to resist. I think as an industry, we can, help prevent. I think prevention will be critical. That's a service that insurance companies sell to their clients. I think it's an amazing way to interact with our clients. So prevention is going to be a key element of it. And then obviously we have to be here when it happens, support our clients, and pay if we need to pay. And I think that AI is just the first step. I'm afraid that quantum computing and AI will be the devil, and that's a whole new level. But again, as an industry, we will cope with it. I'm sure we will cope with it. We have coped with so many disastrous natural events. We will find a way to cope with this too. So again, even then, this will be an opportunity for us.
Well, thank you. I like the positive spin, Mark, Thierry. I like the optimism. This will be, I'll take home from this conference this spirit. There is one last topic I'd love to cover within the space of AI, which is very, very dear to my heart. It's responsible AI. All these new tools and new technology are exposing new ethical problems, new privacy problems. How far can AI go in dealing with personal information? Or how can we use third-party data for our benefit, for benefit of our company, and to get more revenues from our clients? And I'm sure you heard many times, what US invent, China copy, Europe regulate. Is that true or not true? I want to go back to Andreas to follow the conversation. Do you think the regulation will step in this broader space of AI? And if that's the case, is that a good news or a bad news for our industry?
Regulation is absolutely necessary in our industry. We're a highly regulated industry, but we also have to acknowledge it's new to everyone. Every party that comes together has to learn. And it's not about waiting for the regulators, it's really embracing it and approaching it proactively as we build, for instance, agentic AI solutions or other type of AI solutions. We need to see where is the relevant interface to the regulator, what's the interest of regulators, and we need to anticipate. Because if you think about an underwriter today who's learned for decades, the handcraft, and we heard it yesterday from Evan Greenberg, I loved it when he spoke about the handcraft, Those are traditional ways of looking at underwriting and at risk and pricing risk, In today's world with AI, if you build AI on historic processes, it doesn't really work. So you have to reimagine, which is so difficult because you have to learn to forget and then anticipate, look at something, visualize something that it's not there yet. And that's why we say anticipation is always important for leaders, to be curious enough and also technical enough, to pursue this avenue. Secondly, you need self-motivation. It's always what I said. Self-motivation is so important because everybody will tell you it doesn't work. People don't like change. They say they like change, but actually they don't like change. So that's why you have to self-motivate yourself all the time and find successes, little milestones, celebrate them. And lastly, you need inspiration because ultimately you will have to take the people along. You need inspiration. You need to translate it into people's world. Now, the regulator comes in here because as you reinvent the underwriting process, you have to find out at what point do I need to bring in control functions, second line of defenses, etc., and where's the interest of the regulator. So we engaged in discussions with regulators, and we tried to find out how do you do this really. And I had a workshop with Palantir. And I said, if we work on the basis of our analytical data models and bring in your AI platform from Palantir, how can we engage with regulators? I mean, how do we technically really do it? And that was a new question for them. So I said, let's work on maybe a few options. One is, within the AI platform, you create a secure subtenant almost, private, secure subtenant where you give regulators access to the kind of data or models when you do model validations, for instance. That could be one way of doing it, but that requires educating regulators to work on the platform with data models that they haven't had access to before. There's one way of doing it. The other way would be to basically create a digital twin of your environment, the secure environment, and hand it over to the regulator and say, look, you can now work with it, and we have a protocol how to interact, how to sign off also. So what I'm trying to say is you got to, again, be very creative and open up. It's not a tech problem. We will very quickly say it's a tech problem. No, tech is the enabler, but you need to look at who are the stakeholders, who are the actors, and what's the interest that needs to be pursued, and what problem do we need to solve here. So engage with them early, be positive. I see a lot of situations where people are defensive, on both sides, by the way. So we need to be positive, embrace it, and solution-oriented.
Wow, thank you again. This is a very big topic. I want to go back to Paul. Paul, you look at AI from a different vantage point, from Africa, from India, from other markets. I think we all see that some emerging markets, India in particular, is been adopting AI at the speed of light. And at some point, the freedom you enjoy in some other geographies might become an advantage, even to take on more market share and more leading position in Europe or other developed economies. Love to get your thoughts, if on the regulation topic, but more broadly about the use and adoption of AI in your markets.
Yeah, look, I think I take a slightly different view to everybody else. I agree that we also had hundreds of use cases going on, and we've scaled that right back for similar reasons. But we need to remember that when the smartphone was first built, it did not use one piece of new knowledge of physics from the previous 60 years. Every piece of knowledge that was required to build it was available 60 years earlier, right? It took a lot of time to figure out how to use that knowledge to put it together, right? And I think in AI we're going to have a similar thing. I think it's going to take longer to impact than the hype suggests. But I think when it comes, it's going to have a massive impact. I think that'd be my take out on it. And we've got some interesting use cases. So a lot of our customers are over indebted. We have a coach for people that's completely AI driven on credit, and it's actively used. We've trained up financial advisors to do sophisticated financial advice. It does it better than humans, but we have not let that loose, and I'm not sure when we will, because that's a different beast for us in the credit space. Clearly, we're not competing with our own distribution. So all the signs are there of being able to do things very differently. And you're right that in a certain sense we do have more freedom. It's quite interesting. I'm sure many of you know that the first heart transplant was performed in South Africa ever. And the real reason for that was that Christian Barnard was competing against an American cardiologist to do it, and the Americans had much stricter ethical and other rules in place, and so he won the race. I don't know his name. I don't think anybody knows his name. Everybody knows Christian Barnard. He had fewer regulatory barriers effectively to innovation, right? So we do have that, but unfortunately in some of our markets we also have very negative regulations. So a lot of African countries do not permit you to put anything in the cloud. They insist on everything being held locally. Now, if you think about that, that is a massive disabler to us when you're trying to operate at scale and low cost. So it's a mixed bag. But I would say things like machine learning, data analytics, these are extremely well advanced. And it's only some of the new things that we need to start looking at. And I also think that we spoke very much about, again, P&C business, underwriting. But actually, most of us have HR departments, marketing departments. You can really revolutionize now some of those functions, and you're going to have to, because your HR department is going to be bombarded by applications generated by AI. Your few staff in HR are not going to be able to process that without some tools. So I think it's a bigger problem than how do you apply it to underwriting P&C. Yeah,
it's fascinating times. Mark, I'm coming to you, and let me try to connect a few of the breadcrumbs that the last conversation highlighted. Technology is available, has been here for a long time, actually. You need to engage the regulator early on, make sure they understand what you are doing, what your company is doing, but regulators are following and eager to be engaged. And technology can unleash the potential of the industry and break some of the barriers. Let me put all these three things together and come back to what Key is doing in the space of algorithmic underwriting or digital follow, use the name you prefer the most. You've been really innovating in your space, and I'd love to hear a bit more about how you connect the dots in your business.
Yeah, if I go back to why we started Key, it was about solving that problem in the market of speed of use for a follow piece of business. So in follow, we're following a leader who's already set the price and the terms and conditions and the structure of a risk. So there's a lot more data coming in as a follower, and we're able to really speed up that transaction and provide that efficiency to the broker. So that's the problem we're trying to solve. What we then did is we stepped back and said, well, how do we rethink how that transaction is performed? How does that transaction happen really, really efficiently? And so we're trying to come up with ways of working that are very different from the past, if that makes sense. So everybody else was thinking we need to follow these human-led processes. And we were thinking, well, if we just started again, how would we serve that customer in the most efficient, effective way? So having that freedom of thought, which I think is a topic that's come up a few times, is really, really important. But to the regulatory theme, I was at the time, I was the group CFO of Brit Insurance, one of the bigger companies in the Lloyd's market. We really came at it, and we're part of Fairfax. Sorry, I didn't mention that earlier, but we're part of the Fairfax group. So we're in this dynamic environment where we have a shareholder that's happy for Brit, as I was in at the time, to operate on a decentralized model. So we're able to innovate and incubate ideas at a local level. Then we were thinking about how do we solve a problem for the customer? And then we were thinking about, well, how do we do that safely in a heavily regulated insurance environment? So we had to build effectively a new model for insurance and build it in a way that was safe and secure. So we've built into our processes a lot of the institutional knowledge from Brit, from Fairfax. We've used that data, we've trained our models, and then we've wrapped it in what I would consider a safe environment for insurance. So we have all of our models are validated before they go into our live environment, and they're static models. And to some people in technology, that might sound archaic, but we find it, we'd rather call it safe and validated and something that you could explain to a regulator. And then we've put in place, if you like, the institutional processes around measuring your exposure as it comes on through the year, managing all the different risk metrics. So I'd think about it as it's sort of how do you deploy technology in an insurance environment? And I've said this a few times, we're not people from Silicon Valley who've turned up in Lloyd's and had a go at insurance. We're people from Lloyd's who've partnered or brought in expertise from a technology background to solve problems that we know exist in our market. And I think that's the power of people in this room. We know where all the problems are, right? We know what can make our businesses and our interactions with our customers better. Those are the problems we need to solve. What we need to do is to bring in the talent and bring in the new ideas and the new technology to solve them. And frankly, we've got tons of experience in doing that in a safe way. That's our business, right? Risk management, and being able to explain that to a regulator is part of our DNA. So to me, I think that's what the essence of Key is. When I look out and I look at some of the things, we call ourselves algorithmic. That's because we use machine learning models and data to make decisions. And we're doing that at an individual risk level. So every single risk we're looking at and we're pricing it and we're assessing the downside and we're thinking about how it aggregates with our portfolio. So we're really underwriting on a per risk level. What I think is a bit more dangerous is when other people start calling themselves a buzzword, like an algorithmic follow broker managed something facility, something like that. When you look at these vehicles and you start to unpick what's actually happening under the surface, it's very, very different. And that, I think, is where we need to be quite careful as an industry, is when these buzzwords are used and it's nothing under the surface, and it's at best kind of once a year have a look at some data in a spreadsheet. That isn't underwriting. It's not truly algorithmic. So for me, the thing gets a bit dangerous when we don't differentiate between different business models and different quality standards. And so that's where I would focus as an industry. I'd focus on doing things properly, doing them really well in the spirit of the rich history we have, not trying to do them really quickly and cheaply and skip a few steps in the middle. That's not good innovation. So hopefully people can try and filter between the two.
Wow, a lot more to follow, right? Not digitally, but in general. It's definitely the beginning of many new innovation here. Let me switch completely gear for a moment and completely change topic and go to the asset side of our balance sheet, the investments. A lot of changes happening also on the asset side. The name of the game is called private credit, which is now in everybody's mind and everybody's attention. Andreas, I'm going to start with you one more time. And what's your view on this private credit? Is this here to stay? Is this a new asset class, or at some point it will be just more the same?
No, it's here to stay. I mean, it has been here for a while, actually, to be quite honest. So why is there this noise at the moment, this hype, or the discussion around private credit? It's perhaps because people suddenly get nervous. And again, depends which stakeholder group you ask. So I had a conversation with a regulator, or with a Bank of International Settlement, by the way, yeah, based in Switzerland. And they got very nervous because they say it's unregulated balance sheets or capital assets. And that's something that we don't understand. We don't understand what's happening behind the scenes. And what is our role to play as regulators? And then when you look at the real cases, I mean, Swiss Re is known for transitioning from the liability side to the asset side and then capital markets. So that's where Swiss Re was playing all those years. And it was also a sweet spot to a certain degree, IIS and all these topics. But when it came to the new world where the underlying policyholder is still the same, and the discussion shifted from dealing with the customer in basically optimizing the use of capital. That's, for me, the financial engineering element that kicked in. And that's all fine until now. But the question is really, what happens? Where's the tail risk? Who sits with the risk? And what happens in the moment when the customer needs the money? When the customer doesn't even know what happened behind the scenes. So I think we as an industry have a responsibility. And I really think we should talk more often about the customer and the policyholders in this respect. I'm not saying everything's negative, but it's also who's chasing what margins. I sometimes saw situations where we saw blocks of businesses going into the space that you just mentioned because people were gathering assets. Assets under management was the topic, and there were nice fees to be made. But then they needed an underwriter for the biometrical risk in the life and health space. And if you don't leave enough money for the underwriting, where the ultimate balance sheet actually sits, then things are not balanced. And I think things always work out when there's alignment of interest and also when the policyholder interests are still protected. So let's put it there for a moment, because you see a lot of variations. And that was the talk in Monte Carlo, by the way. I heard a lot of people saying there's this tsunami of capital, alternative capital coming our way. And I'm like, give me the numbers. I don't see it really. And then they bring individual cases, and it's always the same case that people refer to in the P&C space. It's always the AIG case with Blackstone. I say, give me another case. You see, and then let's go into that case. Those cases are highly bespoke. So is it really replicable? Is that scalable? It is a very bespoke case. It took, I don't know, almost a year to find a contractual solution for that. So, and there's a reason for this, by the way, yeah, for this deal. And that's okay. It's not that it puts our industry in danger. there's always the need for good paper, regulated balance sheets, strong balance sheets, because cedents in the reinsurance world, they need strong lead reinsurers. It will never be substituted by something that is not long-term and stable and safe. So,
Well, Thierry, I'll pick up on what Andreas just said and coming to you. I would argue the winners in the last few years have been these private credit players, the Blackstone, the Apollo, the KKR. Their valuation is through the roof. Not this year particularly, but if you take a 5-year average, this clearly have win in the market. And they are looking now at insurance balance sheets to continue grow their private credit business. 50% of new private credit funds are funded by insurance. Tell us your view. What do you think? Is the insurance industry becoming more of an asset play or not?
Yeah, so I mean, we all observe these asset companies, right? And it's clearly what's going on is a winner's curse, right? So we all talk of those companies that win and are extremely successful. They scale up at the speed more than anyone else, and that's why they are the winners, right? The prices become super competitive, ultra competitive, so that even companies with relatively large assets actually sell them to somebody else to make it even bigger, right? So that's the competitiveness of that space. But when you're winning, then there's still a lot of money to be made. Now, asset gathering is obviously something that's critical for that industry, which is why on the life side, they have gone on to these very large in-force type deals with biometric risk and a lot of asset risk. So very large transactions have been made around the world. And I think this will continue because the asset gathering industry is very keen, has a lot of appetite for this type of risk. Now, we've heard from Andreas, but we read it in the news that obviously they also play in the P&C space. I think one is, of course, that structure that Andreas alluded to, but there's much more going on, right? There are lots of sidecars being built in a very flexible way by smaller participants, more private equity type players. And they're quite keen to get access to this stream, right, of assets, of fresh cash. Now, and I just built the case a little bit, right? So where do you get a lot of fresh assets? It's in US casualty, right? So you go into US casualty, but you somewhat have an appetite for 5-7 years only. So after that, you give it back to the carrier, right? In terms of cap, you might be interested in a loss ratio that is a bit worse, but not too much. So you put another cap. So when on our side, when you're on our side, right, and you engage with such companies, you have to be aware of the limitations of that coverage very clearly. This has to be eyes wide open, and I'm sure that our clients know exactly what they are doing in that space. But even if, right, there are no caps in time or loss ratio, even then, even if they give you unlimited and uncapped protection. Look, we are dealing today with claims from the 70s in US casualty and 70s, right? But it's how long we're in the industry, right? And a lot of reinsurers are there for more than 100 years even, right? I don't know, right? I just don't know whether those counterparties will be here in 50 years, even if, in theory, they promise to be there. So that's totally untested. And just reminds me of one thing I have learned at the end of the 90s when we did a lot of cool structures for our clients with super AAA structures, that went really sour in around 2007-8. There is no free lunch.
Yeah.
There is no free lunch.
No free lunch. Wow.
And I think it does have a little bit of a negative impact on our industry overall.
Yeah, I think GB. I would agree with Thierry. We've been doing private credit in our business for 30 years, and clearly we're backing our own liabilities with those. So we have a risk appetite for credit that reflects, that we're sitting as shareholders behind it. I think that the build-up of private credit in the form in our industry that it's been going on is extremely worrying because these are new actors, right? And I think the thing that nobody's spoken about here is that quite often that is the debt that is leveraging up an equity position as well, right? So people are approaching this, that industry is approaching it with a very different risk appetite to either banks, right, who are heavily regulated and have to think about liquidity and solvency and put up piles of capital, or insurers who are concerned about policyholders. And the thing is that this thing can wash over onto all of us, because if we have an event, and the problem with credit is actually it has a domino effect. So if you have a fire, right, somewhere, or it's contained in that area, with credit it isn't. When one falls over, miraculously, something that you never thought about tips over because everything is connected. And we can have a very ugly situation in our industry, and our policyholders who have no idea how any of this works will wake up one morning to find that there's a problem. So we should all be very concerned about it.
Thank you for sharing. With such a group of panelists, we could continue for the next 2 hours, but we won't. I want just to take 1 minute for final remarks from each one of you, going perhaps this way from Thierry, and we finish with Andreas. What you would like that we have touched and we didn't? Is anything you want to share with the audience to close the panel?
Yeah, maybe you haven't touched on the topic of talents.
Yeah.
I will be very short, but I do believe that in an environment that is so volatile and uncertain, that we are this rock in the sea, right? We can provide resilience. We have amazing propositions, jobs for people who really want to work on real-world problems, do something good for the world. I think we have very high ethical standards in our industry, and I see our industry as very well positioned in the war for talents in the years to come.
Thank you.
Maybe from me, in the spirit of this meeting, we've used a lot of partnership in our business. We haven't talked about partnership, so we worked with Google Cloud, we worked with University College London, we worked within the wider Lloyd's environment, and now we're partnering with other carriers. And we think, in our mindset, if we've developed some good technology that's useful to other people, be it our brokers or other carriers, then we'd love to have that conversation. And likewise, if we don't know something and we're not the experts in it, we want to bring experts into our business and partner with other people. So I just encourage people to not imagine that they have to build everything or think of everything themselves, and maybe work together to solve these problems.
Maybe, GP, to take a completely different perspective, I would say that if you think of retail clients of financial services around the world, the opportunity to run ecosystems and to enable that with AI and technology. So in our Indian business, we aim to engage twice every day with every customer.
Twice a day?
Every day. Think about that in the insurance industry. I don't know when last, Andreas, you engaged with a customer.
Twice a year would be a lot.
This morning.
A retail customer. So it's a very different world we're moving into, a consumer world. And I think that the technology has a big role to play in that space.
And maybe building on that, I think we didn't speak about, or enough about, the role that our industry plays in society. And how can we communicate the value proposition to our society, because buying insurance is actually not the most pleasant experience for people, because they think about something negative. And there's a lot about NPS and all these things, but that's all the technical stuff. How can we explain our value proposition and the need of insurance and reinsurance to the end customer?
Fantastic. Really, thank you. Fantastic panel. Please join me in thanking the panelists for sharing their insights.